Hi, this is Anthony. Welcome back to my show. So, the stock market just closed about 3 minutes ago. Overall, both of my accounts, my regular account, my Roth, were up a combined 1.07%. Pretty good for one day. They've obviously done quite well this year. Most of my stock is in uh, higher risk things like AppLovin, Palantir, Nvidia, stocks like that. I just sold, as I said in a previous video, half of my 100 shares of Amazon. Not because I don't think that Amazon is doing well, but it's not doing as well as some things, and I want to just diversify. But um, Amazon's a good company, and if you have any mutual funds, Amazon is probably in it. Now, I think for many people who don't want to spend every day looking at the stock market, investing for the long term in some broad based mutual funds is probably the way to go. I think for a lot of people, if you dollar cost average from now until your retirement in something like SPY or VOOG, which matches the S&P 500, you should do well, along with putting some money in maybe QQQM, maybe DIA. Anyway, you hear a lot of people talking about either SPY or VOO on other YouTube channels. Now, I sold my SPY and eventually I bought VOOG. So, what's the difference between VOO, which is like SPY, and VOOG? So, AI tells us VOOG has outperformed VOO over various periods, including year to date and the past year, primarily because VOOG focuses on growth stocks while VOO tracks the broader S&P 500 index. For example, as of mid-November 2025, VOOG has a year-to-date return of around 19.12% compared to VOO's 14.42%. Over the past year, VOOG returned about 24.12%, while VOO returned approximately 15.10%. And year to date, VOOG 19.12% return is significantly higher than VOO's 14.42%. Now, if you're getting 14.42%, that's nothing to sneeze about. You should be happy with that. If you can make at least 10% per year on average, you're doing pretty well. And remember, these are not, these are weighted averages. You're going to have a lot of the Magnificent Seven in them. So VOOG's return was about 24.12% over the past year, surpassing VOO's 15.10. Growth versus broad market. VOOG is the Vanguard S&P 500 Growth ETF, which focuses on large cap stocks with a high growth potential. And I looked it up, and it has, I don't know, just roughly, and I may be off a bit, but like 250 stocks. Doesn't have all 500. While VOO is the Vanguard S&P 500 ETF, which tracks the entire S&P 500 index, including both growth and value stocks. This difference in investment strategy explains VOOG's higher performance during periods of growth or when growth stocks outperform. Will they continue to outperform? Will we have a market correction or a crash? Are we in an AI bubble? I don't know. But again, I'm holding all my stocks for the long term. Now, I do trade in and out of certain things every once in a while. If I get overweighted in one and it's gone up quite a bit but starts slowing down, or if something is just going down, I'll get rid of it or pare back and buy something else. So, but I think for a lot of people that don't want to actively manage their stock accounts, if you just dollar cost average into one of these or a combination of them, you should do pretty well. Okay, so let's look a little bit more. This is the first time today that I've looked at Portfolios Lab. It gives some more information. Do your own research. Don't buy anything just because I or anyone else on YouTube has talked about it. I'm not a financial analyst. I'm not a financial advisor or a stock analyst. I'm just somebody interested in finance and the stock market. So here VOO is, I guess, teal color, and VOOG is the gray. That's the one we're looking at. So 6 months, VOO is doing well. Year to date, it's doing well. 1 year, very well compared to VOOG. Here it's slightly ahead for 5 years, but if you bought both of them 5 years ago, you'd be roughly the same. I think VOOG looks like it's about 108% and change gain, and VOOG is 111.92%. And I don't think that this takes into account dividends, and we'll get to that in a while. And then 10 years, VOOG has done quite a bit better, but still, if you had your money in SPY or VOO, you'd be sitting pretty and you should be happy. Okay. There's a bunch of things that most people, including myself, don't know what the difference between Sharpe ratio and Sortino, Omega ratio, Calamar and Martin ratio. Here's returns by period, VOO on top, VOOG, the one that I'm in. Generally doing better. 1 month it's down a little bit while the broader market's up. But 6 months it's up quite a bit more. 1 year it's up quite a bit more. Good amount for 3 years. 5 years it's up more, but only slightly again. And then 10 years. And this is probably the annualized. Annualized for multi-year. So all of these are annualized rates of return. Okay. And then VOOG has slightly, about 3 times more expense ratio, but still very little. There's some, again, I don't know what any of those are. But we will get down to, okay, so here is the dividend comparison. This is the most recent. This is going back in time. So the S&P 500 does pay a dividend between about 1.5-2% per year. This is annualized. I think it's paid quarterly. VOOG pays between about 0.5% and 1.5%. So you can see for yourself here. Again, do your own research. But you're not going to make a whole lot of money, but you make a little bit of money with dividends there. Okay, I'm going to end here. Love to hear from you. Check out your other videos. Have you ever considered VOOG over VOO or SPY? What are your thoughts? Hit like, hit subscribe, leave a comment. I read them all, and I answer them eventually. Thank you so much for your time. I really do appreciate it.